Good afternoon, everyone. Thank you for joining us. It's been a while since we've done one of these, so I'm excited to hear what Dave has to share with his new correction coming, question mark. As always, chat with questions. We'll watch those as we go through and answer some, maybe intermittent, but probably after we're done. You can also raise your hand and we will unmute and you can ask a question to the group. Other than that, Dave, take it away.
All right. Well, thanks, Jen. And thanks, everybody, for taking a few minutes to join us. And I think I'll kind of drop to the bottom line, if you will, and then we'll circle back. So let's start there. And of course, are we predicting a recession? Well, they kind of go hand in hand sometimes, and we'll talk about that too. A correction. And the answer is, of course, we are, because as I always like to give the analogy, there is a correction right around the next corner. We just don't know how long the street is. We don't. We just really don't. And so when you're thinking about a correction, what does that really mean? I mean, is it like what we're having today with the market off 1.5%? Are we talking about this week where we're off maybe 2% for the week? Are we talking about a full-blown bear market, which is, by the way, 20% or more, which is totally arbitrary? And I promise you, if it went down 18%, wasn't really a bear market, it would sure feel like that, wouldn't it? Right? I mean, it's going to be bad, and the news would be full of how terrible it is and how the politicians.
Got your things off and disconnected or something.
I'm not sure why I got muted, but
That's my bad. Everybody, if you please would mute. We get a lot of feedback and I'm trying to watch for them and mute you as we go. And you'll pop to the top. Sorry, I didn't mean to interrupt you, Dave, but you pop to the top. And so when I do that, I can sometimes accidentally mute the person that's talking. So I apologize for that, but please mute. Don't turn on your cameras because it causes a little bit of interference.
Thank you for that. All right. So I'm sure where I left off was we don't really know what kind of correction's coming. They're all different. And we set up these arbitrary things called 5%. That's a 5% correction. A 10% or less correction. Everything up to 20 is considered a correction. But we all know that if you go down 5%, and we're going down this week, that suddenly everything doesn't look quite so rosy and everybody starts predicting that we'll be down 10. And maybe we will, and maybe we won't. And I think that the important thing to always remember, and why I really wanted to talk about this, is that the world looks terrible. The world is upside down. It's backwards. What's right is wrong and wrong is right. And politicians lie constantly. Like that's new, but in some ways it is, right? We're denying, for example, that there is inflation and the problem is in messaging. It's not really there. Don't believe your lying eyes. I mean, that's the message you hear day in and day out. And we're doing all we can to bring down inflation. Well, they can't. There's nothing they can do. They unleashed trillions of dollars. It flooded the system. And that's what you wind up with every single time in history. That's what's happened. And they can't do anything except the Federal Reserve can slowly try to bring it back. But there's nothing the administration can do. Quotes, we're going to lower drug prices or something. Okay, great. But that is not what's going on out there. And so we feel that. We feel that at the grocery store. We feel that when we buy an airline ticket that costs so much. We feel that when we can't believe the hotel rooms are $230 a night for, Motel 6. It's crazy how much prices have gone up on some things. And it's still working its way through the system, as we see now with services and all those things. Okay, that's the bad news. But the market has known this and been dealing with this for a very, very long time. So I just want to run through a couple of little charts here. We'll fill in some blanks. And then I really would like to open up to some questions as well. But let's go ahead and start on some of those slides there, Jen, okay? Because I want people to understand something. Corrections are normal. They happen all of the time. We just haven't had one for a while. The average frequency of a 5% correction is 3 times a year. Well, we haven't had one this year. And as you'll see, I think we had one or something last year. That's all. It's just not much volatility lately. But 3 a year, that's what's normal. Not, oh my gosh, we should be panicking because we're going to have a correction. Corrections are absolutely certain to occur over and over again all the days of our lives. That's going to keep happening. And I will also come back later and talk about what kinds of things we do in times like this. Like, what are we doing? Okay. With investments. Okay. As you can see, about every 16 months, we get a 10% correction or more. It's just overdue. Don't worry, we'll talk more about that. 15%, you get the point. And now, a bear market only occurs about once every 5.5 years. Okay? So, as you can see, it's just really not that frequent of an event. And we don't really talk much about the Dow because, frankly, it's 30 stocks. It's the S&P is a much broader index. Here's the important takeaway from this quick slide. Okay? The last occurrence of these was a while back. They occur all the time. And now as we move to the next slide, I want you to understand this is another way of really looking at it, okay? So how many 5% pullbacks are experienced every year? Okay? You know what's odd about this particular slide? Are the zeros and the ones. That's what's odd. It's not that it's odd that they happen. Now, we could say 24 in a year is an awful lot. That would have been 08. And 11 the following year was a lot. That was a really bad, difficult, volatile time. It was. But here's the reality. It's normal to have corrections. But our human mind, as you see the average there of 4.6, that's the average number, okay? Well, number one, you can't have a 0.6. It either happened or it didn't. But the point here is this. How many times we're right at 4 or 5? Very few. You have way more or way less all the time, gives you this arbitrary average that is often quoted, talked about, as if it's some kind of thing to hang our hat on. Okay? This is overdue for a 5% correction. Okay, well, as you can see by the chart, we have had times where we're overdue. We're overdue for another year. It just doesn't happen, and I don't know what time we're in. That's what this should tell you, is it's not predictable. There's nothing here. Oh, we have an average of 4 times this happens. No, it doesn't. So it just doesn't do that. So here's another look at it. And we want to see, because 10%, that's frightening, right? We don't want to lose 10% of our money. So we have, 500,000 in an account, it goes down 50. Wait a minute, that's as much money as I made in a year. Okay, I get it. We don't like those, okay? And they don't happen as often. But they happen. And you can't really know. I mean, is it going to happen one time this year? Are we done at 11%? Would it be like an 08 again? And then once again, the predictions come out all the time. Come out. Okay? So let me see the next slide here, Jen. And this is what I think is super important to understand on this slide. We talk about bull markets. We talk about bear markets. And here's the thing. Why don't you look at this slide with me and we think about the bears, which is the gold, that's the down bars there. And people will tell you, the average bear market lasted 11 months. 11.1, because we got to be precise. 11.1. Does anything on here look like 11.1 months? We got a 7, a 6, a 1.2. You see what I mean? We've got, 30 days or something like that in 2020. It's all over the place. And yet we continue to come back to this language, this mathematics, this idea that you can kind of have a sense. Well, here's Wall Street's person on the far right wing radio said this, okay? And the left wing radio over here said, or TV program talked about that, okay? Because again, they're trying to make some point, right? So it's Trump's going to do this, Biden's going to do that, and all this stuff is going to be thrown into this year of a wonderful political election, right? But look at these things. We go from 3 months, 30 days, all the way up to almost 2 years for bear markets. It's totally normal to be abnormal. We don't want to be thinking about this as if you can game this from some, well, and then as we look at the bull markets, it's really the same thing. We really should be only going about 4 years with a bull market. But here's one for 12, right? Again, it just 12 years. It all falls into this average, which doesn't occur. And I want to remind you about why this game is so dangerous to play, about overvalued and undervalued, and how we use mathematics to somehow determine the indeterminable. When is the next bear market? When's the next correction? Why don't we sit it out? And so let me show you to remind you, this is one you've seen before many times. And that is this, where we laugh about this, and I quote this all the time. The S&P 500 has an average price to earnings ratio. That's a valuation technique that says companies are earning X or Y, and on average, they trade at about 16.6 times. And if you look at this chart closely, you will notice that it spends almost no time anywhere near 16.6. Almost no time. And when we think about this, is how many trading days to actually hit 16.6? Fewer than 10 in a 30-year period. I mean, this is actually it's 40-year period. This is an absurd thing that we get shot up all the time. I'm going to go ahead and pick on J.P. Morgan, okay? Because J.P. Morgan came here in June of 2022 and told us the market was going to be somewhere around 3,200 on the S&P. That was their prediction. They were very doom and gloomish, right? Okay. So as we look at that and think about it, that's really solid, thoughtful, mathematical advice. And as we sit over 5,000 today, it would have been devastating. I mean, just devastating to sit it out waiting for a correction that never came. The market kept rolling. It's not predictable. JP Morgan wasn't alone. I'm not just picking on one company, but the idea that you can put this stuff to a mathematical test, that you can predict corrections because they occur 3 times a year, or they occur a little over once a year for a 10% or greater, or whatever the news is. All we have to do is really look at and think about what's happened in our markets over the past couple of years. And recognize how wrong everything from the Federal Reserve telling us they would raise rates 1/4 of a point increases, how inflation was transitory. And the 3 turned out to be over 4% increase in a year. They're off so far, it's like a planetary distance. They are so bad at this, and they're the ones that set the rates. And we can't wait. We sit around and flap our gums about the Fed's chirping here about this, right? This week. Oh, the chairman's going to speak. Are they going to move rates in June? No, not now, because we can see an inflation number that came through. What were they predicting a few months ago? 3 rate cuts. We haven't had one yet. They were predicting one by the end of last year. Markets are wrong all of the time. And that would be devastating, wouldn't it? Because the market needs rate cuts. We haven't had any, and the market hits all-time highs. Oops, another prediction wrong. We can't predict these things, and that's what's important to remember. We have to have the kind of humility that says, I know we'll have corrections, but I don't know when, and I don't know how severe. It's not something you can measure, okay? But I will say this, with portfolios, what we're doing is we're holding just a little bit more cash than normal. In other words, as dividends come in, as interest payments come in, and everybody has a different portfolio, and those that are more conservative are going to look even more conservative, okay? Because we need to have income, and we're building up multiple years, okay? Multiple years on this particular when markets are at all-time highs. So that's what we're doing, because we also can do what? We're getting 5% in money markets. Money markets, totally safe money markets. I'm getting 5, and not long ago we were getting 0. Nobody was talking about money markets because we couldn't talk about money markets. They weren't doing anything. And so what we're doing is now we're able to buy some bonds if if the portfolio calls for it. Growth is still growth for those people that are trying to grow their assets, aren't too worried about volatility. And those things are that's been great. But there's nothing wrong with having a little bit of cash if we get a correction and we get an opportunity to buy high quality things at a discount. That's what we try to do. That's what we want to do, right? But that's not predictive. We know things are going to happen at some point in time. Now, here's what's going to happen. Sometime, the market's going to go down 5%, 6%, 7%, whatever, right? And it's like, oh, okay, well, we're going to go buy something. And then it's going to keep going down. You can never time the bottom or know when this 6% correction is going to turn into a 10 or a 12 or a bear market. People talk about it all the time. We're optimistic on the market. We're constructive. We're cautiously optimistic is my favorite stupid term, because that really says nothing, right? We're cautiously optimistic. Yeah, I told you we were cautious. I told you we were optimistic. You get to have it both ways, right? So you're never really wrong. And that's why it's really important to understand how wrong everybody was collectively, and how wrong the big investment banks were, and how wrong, particularly, the Fed was. How wrong they were. And if you based all of your investments on that, how bad that would have been for you. And not just the last couple of years. This is why we always continue to say you can't possibly time the market. We can't. And we're not going to start doing that today. What we have been doing is taking cash and investing it in money markets. And once in a while, we have been able to go in and buy a particular sector. Now, you see this in your portfolio, so I'll just go ahead and talk about it. And that is, for example, in real estate, which hasn't been performing very well. And again, let's be cautious here to say all real estate is not just real estate. You see the empty buildings in San Francisco. That's not what we're talking about. I'm talking about the general sector, whether it's shopping malls, which nobody shops at, except maybe they do, because you know what? Shopping malls have had record revenues, record profits in the past 12 months. Yeah, I know. You don't see that or read about that. You read about the empty ones that nobody's visiting in the middle of Iowa or something, okay? But there are places that are doing well. There's real estate that's doing very well. We want to own that. And when we sometimes get a little pullback in the market, then that can pull back even more. So a 5% correction or even a 2% correction can turn into, or even a sector could have a terrible time. Energy is another one we've been buying over time because it hasn't gone anywhere for a long time. And oil prices are fine, and they're very profitable companies. And why not? They pay good dividends. So when we think about the market, we do think monolithically, like all stocks are the same thing, and they're not. They're not at all. They're not the same thing. They're all different. So you'll have stocks this year that are up big, and you'll have stocks in the same sector that aren't doing very well. Difference between Delta Airlines and United is night and day. Southwest can't seem to get it right, and they were the darling 5-10 years ago. I'm not saying we should buy airlines, believe me. I'm just saying those are classic examples of extremes in an area that you would think was doing very, very well, because aren't we paying a lot for airline tickets? We are, right? So all of those things are saying there are opportunities within a market, there are corrections within a market and on individual stocks that don't really mean that the market, they're not at all-time highs. So we're always on the prowl for those types of things, and that's what we're doing. But in the meantime, it's nice to get paid on cash and bonds and things like that. It is nice to get paid while we wait for the inevitable corrections that occur in various areas and in the general market. And maybe, just maybe, we are now, because let's face it, the market looks really bad this week, right? We're off 2%. That's not what it's going to feel like, okay? It feels worse, right? And you hear Wall Street always talking about what the whys, okay? We're worried about interest rates. The Fed is not going to drop rates, blah, blah, blah. Well, they haven't dropped them, and the market's rolled to all-time highs. But that will still be the story right now, today, okay? So, predictions? Not with any certainty. Prediction, yes, broadly, we are going to have corrections. And within sectors, we're going to have a lot of corrections, right? Energy is going to be good, and it's going to be bad. And there's all these rotations that occur all of the time. You can't own technology stocks in a rising interest rate environment. That's what Wall Street told you. You can't do that. And if you'd followed their advice, you would have missed one of the greatest tech rallies in history. Really. It's much better to just turn off the predictions, no matter how you feel. It will not help you the more you dig. It will steer you further from the truth. The more you think you're learning, the more you think you're following the markets. The truth is, owning the great corporations of the world over long periods of time, there's no comparable income to that on the planet. There's no comparable growth on the planet. There's no comparable ease of doing it, costs of doing it. Nothing compares to the creative destruction that the stock market offers. Nothing. And the only thing we have to ever deal with are the optics of that they're priced every day. And the noise of an entire industry that pretends they can predict things, that pretends to be super smart. We have our, strategists here. Well, I'll tell you what, when JP Morgan was here, this was their national strategist. Oops. Again, not trying to beat up on their wrong predictions. It's more like, why predict the unpredictable? So we don't want to live in that world. We want to know we are going to have corrections, and you want to know what we're doing about that, about the inevitable correction that's coming, because that's true every single day. It's coming. And as soon as we have one and then come back from one, we're waiting for the next one. And all of those slides tell you there's no way to predict it. None. Absolutely not. So let's not do that together. Let's just march forward and know that as conditions change, opportunities pop up, we're never going to get the best price. It just doesn't matter. It doesn't matter. You don't have to get the best price on Apple over the last zillion years, right? Since the iPhone came out. You just had to own it, and it works. Since the iPhone came out, I'm updating this because I like to use this example. So I'm going to borrow it right here because I wrote it down. I've been saying it's up 40-fold since the iPhone was invented. It's not anymore. It's up 70-fold. 70 since the iPhone was invented. The iPhone is not old. It's not even 20 years old. It changed the world. And you could have bought it any time, and it would have been a great investment. And that's what we're talking. Not going and buying Apple, just understanding that it takes time and time in to make these things work and to turn them into home runs. I know a lot of you, probably all of you, really, at times look at each other and go, I never dreamed I'd have this much money. I mean, it's just insane how this growth has happened. And I think that's just a lesson for us to just sometimes not sit back and go, wow, this is great and it's never going to go down. And oh, it's just, let's not worry about it. Let's not. It is going to go down at times. It's going to have a bad week. It's going to have a bad month. It's going to be a bad year. And it wasn't that long ago, but then we just go, oh, okay, 2020 was straight down and straight back up. And then we had another one in 22. Okay. And they told you at the end of 22 not to own stocks, especially you couldn't own the tech stocks that proceeded to go up somewhere around 45 to 100%. And we're not talking about new startups. I'm talking about Facebook up 100%. We're talking about NVIDIA up multiples. We're talking about Apple, Amazon, Microsoft, all these companies up 45% and more. You don't want to miss that because somebody is blabbering in your ear that you can or can't do something during certain times. When you get price corrections, we own. You buy. That's how we win. All right, let's take a few questions, Jen.
All right. So really, I'll weed through this. We really have one that just talks about technical measures. Do you use alpha or beta or any of that to determine your investments?
No technical indicators at all. I think that you can certainly, if you're following in any individual companies, there are times where they are impressive because maybe the market is going down and they're going down very little or not at all. And so therefore, is that something that we kind of notice and maybe say, well, that's a little, but yes, but we're not doing head and shoulders and all of these things. There's one standard deviation away from this or that. Absolutely not. I am going to agree with Louis Rukeyser. These are nothing more than elves that have no, the great Rukeyser always made fun of technical analysis because to me, it's numerology and that is no way to be thinking about a portfolio. Just because Apple is looking strong this week and crossed over some kind of thing does not mean anything more to me than a day, because I'm not a day trader. I want to own a company because their fundamentals are good. And I think that keeps us clean and clear in what our objectives are.
Good. All right. I'm going to go ahead and unmute Mike so he can ask his question.
All right. Hey, Mike.
All right. Hey, Dave, how you doing? I have a question for you. I hope I asked this correctly. And if not, please step in. But it has to do with tax loss harvesting. So, for instance, if this year I had a capital gain of, I'm just going to throw a number out there, of $20,000. And at the same time, I have a stock that I sold and lost $20,000. Is that a one-to-one offset?
It is. You first of all, when you're pairing them up, again, not trying to be an accountant here, but it's pretty basic stuff. Your short-term gains and short-term losses are paired. Long-term gains, long-term losses, meaning over a year held, are paired up. And if there's any differential, then it goes against short-term can offset long-term and vice versa.
Okay, and is that the same if I have dividend gains of $20,000? And also, is that a different
dividends, and there's no offset to dividends other than regular deductions.
Okay.
But the good news about the dividends, qualified dividends, meaning stock dividends, basically, is that they are taxed at a different level, a maximum of 20%.
Okay. All right.
Okay.
Great. Perfect. Thank you so much.
You're very welcome. Have a great day.
You too.
Okay.
All right. Another one, GE, now 3 separate listed companies. Aerospace looks good. Thoughts?
Yeah, aerospace looks good everywhere. I mean, let's face it, the world is all about outer space. It's all about supersonic, hypersonic. It's changing rapidly. Our technology, that's the cutting edge technology. So all of it looks good. And also, we do have to stay ahead of the Chinese and Russians, the bad people in the world. We have to stay ahead of them technologically. So so our Defense Department continues to spend money there. And I don't want to get into whether we should spend more or not. I think we are going to be spending more regardless because we have to keep up.
How much of the market rise is due to the increase in inflation?
Good question. But this could be, so I'm going to answer this a little longer than just saying, well, X percent is. Some of it is. Because what happens is you're also inflating earnings, right? If a company's doing a good job on the cost side, then sales are going up, right? And so they're theoretically making more money. So part of that is the case. But what you really want to do is you peel out the inflation adjusted numbers like we do when we look at grocery stores, right? You don't say same store sales are up 10%. Well, they're not if inflation's 10. If inflation's 8, they're only up 2. And they are adjusted for that so that people understand, oh, we are selling more and therefore doing a good job bringing more customers into the store. So those are important comparisons. But I want to swing back to this because you hear this a lot on doom and gloom. Okay, a doom and gloom, internet, radio, TV, whatever it is. Okay, and that's why this stuff is so dangerous. It really is. I'm not saying you can't listen or don't listen to other people. It's really not helpful if you are reading things online. They just lie about everything. These people don't even exist. Their track records don't exist. And then they are talking about things like inflation is really all there is. Like gold's the only thing on the planet because it's the only real thing. Okay, well, I'm just saying my stock portfolio is up a lot. Okay, and that looks like real money to me. And I can take it out and I can go buy goods and services. And by the way, you can't with gold. You have to go turn it into that fiat currency before you can transact any business at all. So there's a lot of different things out there that are kind of point that way as if the stock market returns aren't real. And they're very real. It's real money. It just costs more to live. That's where the inflation side is, right? It costs more to do anything. To get a plumber to your house is so much more expensive than it used to be. So we all get that inflation is here. It's not transient. It's stuck. And there's nothing JoJo and company can do to except pretend that they're doing stuff. And so there isn't anything. It is going to have to work its way through the system when we have too much money. It is going to take time. But if stocks are up 10 and inflation's stuck at 4, then all you'll ever hear about is the real rate of return is 6. That's what you're going to hear. And anyway, that's an aside, but I hear that, and I know a lot of times that comes from a more of a, if you will, a buy gold perspective. Like the stock gains are not real. They're real.
Okay, good. Does the politically charged environment affect your portfolio in any way? Does November 5th affect your choices?
No, not yet, because we don't know. Will there be areas that possibly are going to be more beneficial if we have Trump? I think the defense sector rallies, for example. I think that clearly, if Republicans are doing well, we're going to spend the money for sure on defense, some of it. We're very far behind, according to everybody, both sides of the aisle. But Democrats are not at this time doing that. So I'm just using one example of that. They are not talking about it or wanting to do anything about it. So I think that you will see some sectors that maybe are going to be thinking there's some things to do, but I think you have to be careful with that. And I really do, because studies show that there's really no long-term effect from that. So we really want to be careful. There certainly are. If tax rates are good, we can expect a better economy than raising tax rates, things like that. And certainly a tax on capital is something we're going to be keeping our eye on. If they want to take and tax capital gains, in other words, if Democrats do well, that could be a devastating blow to the economy. So we would be thinking differently about the growth in the capital markets if we take away the advantages, if you will. Incentives, a better way of saying it. The incentive to save and invest is enhanced when capital isn't taxed greatly. Okay? So there are proposals all over the place and people will talk about it, but that is a really great question. Thank you for asking.
Yeah. All right. So you've had us owning Boeing. Given their issues, is it time to hold or cut losses?
The great question. I don't know. Airplanes are really hard to make, and we all know that. But Boeing is one of two in the world that makes airplanes. Will they be able to fix it? I think so. I thought so. I thought the MAX issue was behind, and then the door flies off. So I think Boeing can't get out of their own way. But the supply chains are so long that in airplane manufacturing, it's not something. Here's what I promise you: if the Chinese could do this, they would. It's hard to do, and so Boeing and Airbus control the entire market. And sure, they can buy less airplanes and threaten this, but Airbus can't make them all by themselves. So I think that Boeing is probably closer to a bottom, just because I don't know what else can happen. A wing fall off? I mean, these are tragic things. I don't mean to make fun. I'm just saying that this is just something else, watching all of this happen. And it seems extraordinary to think another big flop would happen.
Good. All right. Any other questions? I think that's it.
Okay. Did we cover everything, Jennifer? Let me ask you if you have a question first before I wrap this up.
No, I can't think of anything. I think you covered it great, Dave. You answered all the questions we've been getting lately, so I think we're in good shape.
Okay, great. Well, again, I want to reiterate this part of it then, because corrections are happening all the time within this thing called the market. Okay, it's something that we think of as all uniform, but all you have to do is take a step back and say, that's a good point, because I look at my portfolio and some things are doing great and some are not doing so great. And here's the other thing, though: quit looking at it like that, because what happens is these things fit together. Some are in there for just income purposes. Some are in there for more, if you will, more safety. Okay, they're just, we don't look for high growth. Not all of them are going to be Google and Amazon and Apple. They're just not all in there for those reasons. And you're not the S&P 500. So it is important to be sure you understand what it is you're looking at, what you're measuring. And you know what? I wish I didn't own Boeing. I wish we didn't have it in some of your portfolios. And there's other things too. I guess we could spend a lot of time breaking them apart and saying, I wish you didn't have X, Y, Z. I wish you didn't have this one. And it brings me back to this one quick thing I'll leave you with. Warren Buffett says that there are 12 decisions he's made in a 70-year investment career. Just 12 that make substantially all of their gains. 12. Now, 2 of those are personnel. Okay? So there's 10 investment decisions that produced that. The greatest returns by far, nobody's even close. Just 10. And he goes on to say that most of the rest, all of the rest are mediocre at best. They're mediocre at best. That's Warren Buffett. Most things don't work out. Not at all. It doesn't mean they go to zero. They just don't do that well. Most of the gains in the market are centered on a few things, a few companies that just the sun is shining, the winds are blowing, and they're doing a great job in an area. All of it comes together to watch an Apple go up 70-fold. While at the same time, if you owned an airline, it didn't go anywhere. It creates an amazing automobile company like Tesla, while General Motors and Ford die. Just die. They just sit there and get bailed out by the government because it's a big job maker. But they're hopelessly crummy companies. And you look at them and you say, that's all within the market. So when we're thinking about these things and looking at it, it is very few things that really rock and make all the difference in the world. So don't get hung up on 1 or 2 that maybe aren't working now. And I know I don't have enough hands or feet to tell you the number of times that it would be like, why are we in this? And we need to get out of that. And you go, okay, we can, it's okay. And then what happens? And we do the same thing. It's like years ago, it was like emerging markets. As soon as we get out, then they finally have a good year. I mean, it just endless, right? It just goes on and on and on, because sometimes it's not their turn and you don't know when their turn is. It's like the real estate market now. We just feel so good about real estate. I mean, really great about some of it. And it just sits there and pays a nice dividend. It's certainly not rocking and rolling, but it has come well off the bottom. And all you ever read about is that it's just the next shoe to drop. It's going to be terrible, and so on and so forth. All right. With that, I wish you all a wonderful weekend. It's nice to see the weather so great, and we are always here to take care of you. So if you have any comments, questions, need anything, that's what you need to do, is give us a call. Have a beautiful rest of the day.